Welcome back to another video, everyone. In this video, we are going to cover some stock fundamentals. We are going to break down topics such as market cap, tiers of market cap, shares outstanding, shares float, insider and institutional ownership, stock split and reverse split. Now, before we begin, I want you to understand there's a difference between fundamental analysis and there's a difference of what we're covering. Fundamental analysis, which we're going to cover in the upcoming parts, is an analysis that strictly focuses on the company's, let's say, revenue, how much money they make, what the company does, and all these things. What we're focusing on now is a little bit different. I'm just focusing on certain fundamentals that relate to a stock. Some fundamentals, such as the following: market cap, how much the company is valued at, right? Inside ownership, shares outstanding. I'm focusing on certain fundamentals that I think everyone should have a solid understanding of before they begin trading. Now, if you take a look here, there's a lot of different set of information, right? That's where you go deeper into fundamental analysis. That's where you go into their sales, their income, right? You start looking at other sets of factors that involve a company, and that's where you dig into the company fundamentals. Right now, once again, we are just going over certain sets of information that I believe you should have a solid understanding of before you begin trading. So let's get started with the first one. Market cap. What is the market cap? Market cap is the total market value of a company, right? So the market cap, as discussed before, showcases us the valuation of a company. It showcases how much a company is worth. So how do we get to the market cap? So the way we get to the market cap is we multiply the stock's current price. Let's say the stock is trading at $10. The stock is trading at $10. We multiply that by the outstanding shares. How many shares are available for this company? Let's say the company has 100 shares. We multiply that and then we get the market cap, which in this situation equates to $1,000. Now, if the share price goes up, the market cap goes up. If the share price goes down, the market cap also goes down. That is the basic example of market cap, which also once again stands for market capitalization. It shows us the total market value of a company today, right? So today this company once again is worth $1,000. The price of the share goes up tomorrow, the valuation of the company will also go up. Now there's certain tiers of market cap that I want you to understand, right? The first one is mega cap. This is basically any stock with a market cap over 200 billion. We then have large cap. This is any stock with a market cap of 10 billion to 200 billion. Mid cap, market cap of 2 billion to 10 billion. Small cap, market cap of 300 million to 2 billion. And then we have something called micro cap, market cap of 50 million to 300 million. Now there is one more below this. That's like a very, very small cap. Not really a fan of trading those, but you have to understand, as you go lower in trading market cap, so if I was to trade, let's say, a company or stock in this aspect, right, there would be far more profit, right? There would be more price fluctuation, but there would be far more risk, right? So if there's more profit, there's going to be a lot more risk as well. Now, if I start trading a stock that's, let's say, a mega cap, a large cap, right, I start trading stocks like Roku, Apple, Microsoft, Amazon, right? I start trading the bigger name companies, they're going to have less risk, but also less reward. So this is where understanding what stock you're trading is an extremely important thing to know, right? Like I mentioned in one of the previous videos, for this stock to go up 100%, right, it's going to have to add $200 billion, right? For this stock to go up 100%, it's only going to have to add in 300 million. So there is a difference of all of these market cap type of stocks, right? Easier for these type of stocks to go up 100, 200%. For these, very, very, very difficult. Not saying it's not possible, but the probability is very, very low. So understanding what you're trading, understanding what type of stocks you want to trade is extremely, extremely important moving forward. Now let's go over the next concept. Shares outstanding and float. What is shares outstanding and float? So shares outstanding is the total number of shares that exist for a company, including restricted shares owned by company officials and insiders, right? So this right here, which is representing here 118 million. This is the total number of shares the company has, including restricted shares, including shares that are restricted. Now, what is the float? The float is the total number of shares actually available for trading. Now, remember, if shares are restricted, those restricted shares are not allowed to be traded, which is why the float represents the total number of shares that we can actually trade. So if you guys take a look here, shares outstanding, 118 million. Shares float is 84 million. What this means right here is this is how many shares are out in the marketplace to actually trade. Now, what you have to understand with shares outstanding and shares float, if a company has anything lower than 20 million on float, right? Anything less than 20 million, that's considered low. Once again, if a company has 20 million or less shares on its float, that is considered low float. And if a stock has low float, it is easier for it to go up or down. It's easier for it to fluctuate, right? So keep that in mind, right? This has 84 million. Now, if this had 10 million, it would be easier for the stock to go up or down. And this is important to understand because, like I said, once we get to this point on understanding what you want to trade, what your risk tolerance is, understanding these concepts are very, very important, and they're going to play a very huge role. Now, next, we have something called short float. Now, short or shorting is the idea of betting against the stock, right? So when you short a stock, you are assuming that the stock's price is going to go down. Now, a lot of people don't know this, but when you trade, you can make money when a stock goes up, and you can make money when a stock goes down. And I will break this down in the shorting lesson, right? So short float shows us the total amount, right? So it shows the total amount of shares that are shorted. It gives us the percentage of the float that is shorted. So in this situation, it's 10%. That means that out of this 84 million shares of the float, 10% are shorted. 10% of that, people are assuming that this stock is going to go down, or 10% of the total float is the amount of people betting against this stock. Now, usually anything over 20% is considered high float. Now, think about it. If there's a high short float, right? If there's a high short float of 20%, or let's say 30%, that means a lot of people are basically betting against the stock, which creates a lot of negative sentiment or negative news around that stock. And I'll get more into this in the upcoming videos. Now, here, let's go over an example. So let's say we have a stock with a share price of $10. Shares outstanding is 150,000. Shares float is 100,000. So this is time for a test, right? Let's understand if you understood everything we went over. So if the share price is $10, shares outstanding is 150,000, shares float is 100,000, and the short float is 10%, what is the market cap? The market cap. First, before we even jump into what the market cap is, how do we get the market cap, right? The way we get the market cap is we multiply the share price by the shares outstanding. We multiply by the shares outstanding, not the float. The float is what's available to trade. The outstanding shares are the total amount of shares available, the total amount of shares a company has. So when we multiply this, we get 1.5 million. This is the market cap of the company, right? The short float is 10% of the shares float. It doesn't include this, and it includes this. So about 10,000 shares are shorted from this company. Understanding that is very, very important. Now, you guys don't have to do the math. You guys don't have to do any of that. The system will do everything for you. But just having a strong understanding is very, very important. All right, let's look at the next one. Insider and institutional ownership. Insider ownership is shares held by insiders or individuals or institutions owning 5% or more of the total number of outstanding shares. So if you own 5% or more of a company, you are considered an insider. You have insider ownership, right? So let's just say I go in and I buy 5% of Apple, which is a lot and a lot of money. I think it's like $50 billion, $60 billion. I am now considered an insider of the company. I have insider ownership. The second thing we have is institutional ownership. Institutional ownership are shares held by large financial organizations. So if a stock obviously has high institutional ownership, that showcases that a lot of institutions are backing that company up. That makes it a stronger play, right? Now, obviously, I'm going to dig more deeper into this when we get to the fundamental aspect, but just for now, I want you guys to have the meaning behind it, so when you do see it, you're not confused, right? But once again, I will go over and I will break it down more in depth on what we need and what we don't need to focus on. Next, we have something called stock split. So a stock split is an increase in this number of outstanding shares and a decrease in the stock's price so that the overall market cap remains the same. So basically, this is how a stock split works. Let's say we have a 2-to-1 stock split. Let's say a stock is trading at $10, right? It has 100 shares and the market cap is $1,000. Now, when a stock has a stock split, what tends to happen is when it splits this price, and as it splits this price, it takes this price to $5 and it takes this to $200. Now, when the stock has a split, guess what? The market cap stays the same. So once again, let's say that this company has a stock split of 2-to-1. This is the existing amount of shares, existing share price that the company has. The company is currently valued at $10. The company's share price is currently $10. It has 100 shares. So if it has 100 shares and each share price is at $10, the company is valued at $1,000. Now let's say they come out and they say, hey, we're going to do a 2-to-1 split. What does that mean? A 2-to-1 split basically means that they're going to take their share price and divide it by 2. So the share price goes down and it goes to $5. This right here goes up. So instead of them having 100 shares, they now have 200 shares. And the market cap, 5 times 200, is still $1,000. So the bottom line is nothing changes besides the share price goes down and the share quantity or the shares outstanding goes up. Now, why do companies do this? Companies do this primarily to create more liquidity. Sometimes companies do it to create more a lower share price. Some companies' share price goes to, let's say, $2,000, so they tend to cut down the price. Some companies want to have more shares outstanding. They want to have more volatility, more liquidity in the market, so there's more shares to go around. That's one reason why companies do stock splits. Now, beyond stock splits, we have something called reverse stock splits. A reverse stock split is a decrease in the number of outstanding shares and an increase in the stock's price so that the overall market cap remains the same. So for example, we might have a 1-for-10 reverse stock split. It may look something like this. Let's say the stock is at $10. The company has 1,000 shares, right? The company is valued at $10,000. Now, if the company has a reverse stock split, right, what may happen is the stock price may go up, right? So let's say they have a 1-to-10 reverse stock split. The stock price is going to go from 10 to 100, right? And then this is going to go to 100. What happens is this multiplies by that, right? And once it multiplies by that, you get this higher number. And then this divides that number. You don't have to do the math. The system does it for you. If there is a reverse split or stock split, companies tell you when it is. Companies give you an update, and they'll tell you what the price is basically going to be. But if you look at this, the final number stays the same. Nothing really changes. The only thing that changes in the reverse stock split is the price of the stock goes up and the quantity of the shares go down. But the overall market cap, which is what we care about, stays the same. Now, the question you guys have is, okay, why would a company do a reverse stock split? Now, these are companies that I'm not personally a fan of, right? Some people trade them. Some people have their trading styles based on these companies. I'm personally not. I don't trade like this. But like I mentioned, the whole idea of trading is for you to find your own trading style. So just because I don't trade these or I'm not a fan of them does not mean you shouldn't be either, right? So a lot of companies do a reverse stock split because when a lot of companies' stock prices get below $1, right, they get a notice from the SEC, basically the cops of the stock market, that say, hey, we're going to give you X amount of days to bring your stock price above $1. If you don't bring it above $1, we are going to delist you. We are going to take you off of our exchange, right? So these companies, let's say they're at 50 cents, right? They don't want to get off the exchange. So what they do is they would do a 1 for, let's say, 36 split, meaning their share price would go up 36 times, their share quantity would go down, but the market value would be the same thing. Now, what happens to you if you're holding a stock that has a reverse split or a stock split? Now, let's say a company is trading at $10, right? They have 100 shares, meaning their total market cap, their valuation is $1,000. Now, if their valuation is $1,000, and let's say they have a split, right? Their split goes to $5, and they have 200 shares, right? The valuation, once again, stays the same, okay? The valuation on a split does not change. The only thing that changes is the share amount. Share amount goes down, the share quantity goes up. Now, let's say you were originally holding 5 shares at $10, right? You were holding 5 shares at $10. So if you were holding 5 shares at $10, that means you were holding $50 worth of this stock. Now, the stock split happens. You wake up one day and you're like, oh man, I didn't know. What happens now? So what tends to happen is if this goes to 5, right, your quantity goes up, right? So if you had 5 shares, you now have 10 shares, right? And the broker does this automatically. You now have 10 shares at $5. So at the end of the day, your valuation, right? Your valuation right here stays the same, So nothing really happens to you. It's just an idea of knowing what happens with reverse splits or stock splits. Reverse splits are, usually not a good sign. There are ways to trade them. There are ways to use them as a set of news or information to have a good trade. But usually in the long run, reverse splits, from what I've seen, are not good trading plays, right? Once again, just to recap everything we've covered, these are basic stock fundamentals. I'm going to go more and more in depth with each topic moving forward. My whole idea, like I mentioned before, is just to break down the basics and put in piece by piece so you guys have a solid understanding as we start progressing.